Welcome to Charged Alpha. I'm Hudson and Lana is here with me. Today we're doing the full company chapter for Marriott International.
Marriott is one of those companies where the business model is elegant in its simplicity once you understand it. Let's build that foundation before we look at the numbers.
Marriott was founded in 1927 in Washington, D.C. by J. Willard Marriott as a root beer stand. Almost a century later, it operates the largest hotel portfolio on Earth by room count.
The company operates 30-plus brands spanning every price point: Ritz-Carlton and St. Regis at the luxury tier, Sheraton and Westin in the upper upscale, and Courtyard and Fairfield at mid-scale.
The most important thing to understand about Marriott's business model is that it is asset-light. The company earns management and franchise fees on properties it does not own. Capital risk stays with the property owners.
That asset-light structure generates high returns on invested capital because Marriott does not carry the balance sheet burden of hotel real estate. Revenue comes from fees tied to room nights, not depreciation-heavy assets.
The primary financial metric for hotel companies is RevPAR, revenue per available room. It combines occupancy rate and average daily rate into a single measure of how productively rooms are being filled and priced.
Bonvoy is Marriott's loyalty program and one of its most durable competitive advantages. With over 200 million enrolled members, Bonvoy drives direct bookings that reduce dependence on online travel agencies like Expedia.
Direct bookings matter because OTA commissions typically run 15 to 25% per booking. Every incremental direct booking through Bonvoy meaningfully improves economics for both Marriott and its hotel owners.
CEO Anthony Capuano took over in 2021 following the death of Arne Sorensen. Capuano had spent his entire career at Marriott overseeing global development, making him a deep institutional insider.
Capuano's strategic priorities have included accelerating net unit growth, expanding into luxury and lifestyle brands, and deepening Bonvoy's engagement through co-branded credit card partnerships.
Marriott suspended its dividend during the COVID-19 pandemic as hotel occupancy collapsed. The dividend was reinstated in 2022 and has grown each year since, reflecting recovery in travel demand and cash flow.
Hilton is Marriott's closest competitor and operates a near-identical asset-light franchise model. The two companies collectively dominate upper-tier global hotel development and loyalty enrollment.
The pipeline of new properties under development is a leading indicator for Marriott's future fee revenue. The company typically has hundreds of thousands of rooms in the development pipeline at any given time.
Marriott has meaningful international exposure through its Middle East, Asia-Pacific, and European portfolios. Luxury travel to these regions has been a tailwind as high-net-worth consumer spending has remained resilient.
Business travel is Marriott's second demand driver alongside leisure. Corporate negotiated rates and group meeting contracts provide more predictable revenue than pure leisure bookings.
Marriott's dividend yield is modest relative to its valuation multiple. The investment thesis centers on total return through earnings growth and share repurchases more than income.
The 30-brand portfolio lets Marriott capture travelers at every occasion: weekend leisure, business travel, international luxury, or extended stay. Few competitors span that full spectrum.
That's the Marriott chapter. Asset-light, fee-driven, Bonvoy-powered, a hospitality machine built for durable returns across cycles.
Now, let's see how the latest quarter measured up.
Into the numbers. Marriott International beat Q1 2026 earnings estimates by 6.3%. Revenue per available room, the lodging industry's primary performance metric, continued growing year over year as global travel demand remains resilient. The asset-light franchise model generates fee income at record rates with minimal capital at risk. With summer travel season ahead, Marriott enters Q2 with strong momentum. This is Charged Alpha. I'm Hudson.
And I'm Lana. Marriott International is the world's largest hotel company by property count, operating approximately 9,000 properties across 140 countries under 30 brands, including Marriott, Sheraton, Westin, Ritz-Carlton, W Hotels, and Courtyard. Founded in 1927 as a root beer stand by J. Willard Marriott, the company transitioned from hotel ownership to an asset-light franchise and management fee model, making Marriott a capital-light royalty business on global travel demand. Market cap is approximately $95 billion.
CEO Anthony Capuano has led Marriott since 2021, succeeding Arne Sorensen, who passed away during the pandemic. Capuano has accelerated Marriott's brand portfolio expansion, particularly in the premium and lifestyle segments, and has driven the Marriott Bonvoy loyalty program to over 200 million members, one of the largest travel loyalty ecosystems in the world.
Starting with Marriott's financials, Q1 2026 revenue beat consensus estimates, driven by continued global revenue per available room growth across all major geographic segments. Marriott's fiscal Q1 covers January through March, a seasonally moderate quarter between the holiday peak and summer travel season, making the beat particularly meaningful as a baseline indicator for the strong travel months ahead.
Adjusted EPS beat the consensus estimate by 6.3%. Marriott's asset-light model means earnings are driven by fee income, base management fees, franchise royalties, and incentive management fees tied to property profit levels, rather than owned hotel operating income. Fee income is highly margin-rich, and continued RevPAR growth flows directly to Marriott's fee revenue without the capital cost of owning hotel real estate.
Revenue per available room, RevPAR, is the lodging industry's primary performance metric, combining occupancy rate and average daily room rate into a single measure. Global RevPAR growth in Q1 2026 reflected continued recovery in international travel, particularly in Asia-Pacific and the Middle East markets. Domestic U.S. RevPAR growth has been more moderate as leisure demand has normalized from the post-pandemic surge levels.
Marriott's net room growth is a second key performance indicator. The company adds properties through franchise and management agreements, with new signings indicating the pipeline for future fee income. Net room additions reflect both new property openings and conversion of independent hotels or competing brand properties to Marriott's portfolio, a growth engine that does not require Marriott capital investment.
Marriott Bonvoy is the loyalty ecosystem connecting the property network to more than 200 million members. Bonvoy credit card partnerships with JPMorgan Chase generate significant co-branded card fee income independent of hotel occupancy rates. As Bonvoy membership grows, the co-branded card portfolio expands, creating a recurring royalty stream that is less cyclical than hotel room revenue.
Marriott's balance sheet is net debt, consistent with a capital-light franchise company that returns excess cash to shareholders through buybacks. Management maintained full-year guidance after the Q1 beat, projecting continued RevPAR growth and net room additions consistent with the long-term expansion target. The buyback program remains active, with Marriott consistently returning cash to shareholders as the asset-light model generates free cash flow well above dividend requirements.
The analyst community's reaction to Marriott's Q1 beat is constructive. A 6% EPS beat with maintained guidance signals that the global travel recovery is broader and more durable than some analysts modeled. Price target upgrades are expected across the coverage universe as analysts mark estimates higher on the Q1 baseline and positive RevPAR trajectory.
The constructive analyst view centers on the asset-light model's return on invested capital. Marriott owns very little hotel real estate. The physical assets are owned by franchisees and third-party hotel owners, and Marriott collects fee income with minimal capital at risk. This model generates returns on invested capital well above the company's cost of capital, creating value through brand strength and loyalty network scale rather than balance sheet capacity.
International travel recovery is a key bull debate. Asia-Pacific travel, particularly from China, has been slower to recover to pre-pandemic levels than North American and European markets. Analysts who model a continued China outbound travel recovery see Marriott's Asia-Pacific portfolio, including premium brands that skew toward Chinese luxury travelers, as a significant RevPAR upside catalyst in 2026 and beyond.
The skeptical analyst view focuses on U.S. leisure travel normalization. The post-pandemic travel surge drove exceptional RevPAR growth in 2022 and 2023. As leisure demand has normalized, U.S. RevPAR growth has moderated. Bears who model U.S. leisure demand as the primary RevPAR driver see a period of slower growth as the comparison period becomes more challenging and the consumer spending mix shifts away from travel experiences.
Marriott's valuation at approximately 25 times forward earnings reflects a premium to general market multiples, consistent with the asset-light model's capital efficiency and the Bonvoy loyalty moat. Analysts who model continued mid-single-digit RevPAR growth and unit additions see the current multiple as supportable. Those who model demand normalization or macro headwinds view the premium multiple as limiting near-term upside.
The bull case for Marriott starts with the royalty model on global travel. As the world's largest hotel company by room count, Marriott collects brand royalties, management fees, and loyalty income from a network that grows without Marriott capital investment. Net room additions compound the fee income base. Each new property signing creates decades of recurring fee revenue at near zero incremental capital cost.
Bonvoy's 200 million member base is a moat that compounds independently of economic cycles. Co-branded credit card spending, points redemption, and premium tier enrollments create fee income streams less tied to occupancy rates than traditional hotel revenue. As Bonvoy penetration grows globally, the loyalty ecosystem becomes more valuable. Members book Marriott properties preferentially, and co-card spending grows with the member base.
The capital return program amplifies the bull case. Marriott's asset-light model generates free cash flow significantly above the dividend, creating capacity for consistent buybacks that reduce the share count over time. Bulls modeling RevPAR growth, unit expansion, and buyback-driven EPS compounding see Marriott as one of the most attractive capital allocators in the consumer discretionary sector.
The bear case for Marriott leads with U.S. leisure travel normalization. RevPAR growth has moderated as post-pandemic pent-up demand has been absorbed and consumer spending faces more competition from entertainment and dining alternatives. Bears modeling continued U.S. RevPAR deceleration toward flat or low single-digit growth, see limited EPS upside at current fee multiples.
Business travel uncertainty is the second bear concern. Corporate budgets can be cut quickly in an economic slowdown, and hybrid work has structurally reduced midweek business travel at many hotel categories. Bears modeling corporate demand below pre-pandemic levels see Marriott's urban and convention hotel RevPAR as structurally impaired versus prior cycle peaks.
Airbnb competition is a long-term structural concern. Short-term rental platforms have captured leisure travel share in beach, mountain, and vacation home destinations where Marriott's branded product is less differentiated. As Airbnb supply grows, leisure travelers have more alternatives to traditional hotels in markets where Marriott's brand premium is less compelling.
The premium valuation is the bear's near-term anchor. At 25 times forward earnings, Marriott is priced for continued strong execution. Any RevPAR deceleration or macro-driven travel spending compression could compress the multiple quickly. Bears who see the current valuation as a cycle peak have limited patience for near-term headwinds.
Hilton Worldwide is Marriott's most direct peer, another asset-light franchise model with premium global brands. Hilton's Honors loyalty program competes directly with Marriott Bonvoy for member engagement and co-branded credit card economics. The two companies are remarkably similar, and relative performance primarily reflects brand portfolio mix, regional exposure, and execution.
Hyatt Hotels is a smaller premium peer with a higher mix of managed and owned properties versus franchised. Hyatt's World of Hyatt loyalty program is smaller than Bonvoy, but has strong engagement in the luxury tier. Hyatt's portfolio skews toward full-service and luxury properties, a higher RevPAR product that benefits from luxury travel recovery and business travel normalization.
Airbnb represents the most disruptive alternative to traditional hotel companies. While primarily targeting leisure in vacation-specific destinations, Airbnb has expanded into urban markets where Marriott's hotels compete directly. Airbnb's platform economics, no owned real estate, take rate on host listings, create a structurally lower cost model than even Marriott's asset-light franchise comparison.
On valuation, Marriott and Hilton trade at comparable premium multiples, reflecting similar asset-light model quality. Both trade at a premium to Hyatt, which carries more owned real estate. The peer group premium reflects the royalty-like economics of franchise fee income, high margin, capital light, and recurring. Bulls argue the premium is justified by Bonvoy and net room growth compounding.
Marriott's options market activity ahead of Q1 2026 earnings was moderate, consistent with a large-cap consumer discretionary company where the primary uncertainty is RevPAR growth trajectory rather than binary event risk. Pre-earnings implied volatility was below sector averages for companies with more earnings uncertainty. The EPS beat and maintained guidance produced constructive stock reaction without significant volatility.
Post-earnings implied volatility compressed as the beat resolved the near-term uncertainty. Marriott's beta of approximately 1.2 positions it as a mild market amplifier. Options market activity in the days following the beat showed call buying on continued RevPAR momentum, with particular interest in longer-dated options that capture the summer travel season outlook implied in the maintained full-year guidance.
Insider activity at Marriott reflects CEO Anthony Capuano's established tenure since 2021. Scheduled planned transactions are the primary filing pattern. No notable open market purchases were reported in the most recent 90-day window. Capuano has built his equity position through performance compensation tied to RevPAR growth, unit additions, and Bonvoy engagement metrics, aligning incentives with the long-term franchise value creation story.
The combined read from options and insider data is neutral to constructive. Pre-earnings implied volatility was moderate, reflecting low structural uncertainty in Marriott's model rather than bearish sentiment. The EPS beat resolved event risk constructively. Insider activity follows standard tenure patterns. For Marriott, the investment thesis turns on global RevPAR growth and net unit expansion, both of which Q1 2026 supported.
Marriott beat Q1 2026 EPS by 6.3%, with global RevPAR growth continuing across all major regions. The asset-light franchise model is compounding free cash flow at premium margins.
Bottom line, Marriott is the royalty business on global travel. The Bonvoy flywheel compounds membership and co-card economics independent of the cycle. The U.S. leisure normalization is the near-term friction, and international recovery is the upside optionality.
Financial data and charts sourced from Financial Modeling Prep. Charged Alpha is for informational and educational purposes only. This is not investment advice. Always do your own research before making investment decisions. Thanks for listening to Charged Alpha. Subscribe and leave a review if this was useful. New episodes every earnings season. See you on the next one.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.